We continue with portfolio theory, lecture 4, and we continue, so, portfolio 4, and we continue with diversification. Let's see where we were and move on from there. Now, here is the hard part about this. The hard part is that I tried to prepare like last week from the textbook and I didn't understand really well what the textbook was telling me. I tried last night and I still didn't understand it from the textbook. Now the good news is I understood it like 15 years ago when I studied it. So we'll go along with the way I understood it because unfortunately this is not well written. I tried, and it still didn't work. Now, let's begin directly with, well, I have the 169 page with some of the rules. Some of the rules are fairly straightforward. The return of the portfolio equals the weight of asset A times the return of asset A plus the weight of B times the return of B, and presumably the weight of A plus the weight of B equals to 1, and it equals to 1 by definition, by the definition of weight. So, in other words, the return of the portfolio is simply the weighted average of the returns. That's it. Fairly simple. The next simple thing is that the expected return of the portfolio is simply the weighted expected returns of the components. So you have the weight of A times the expectation R of A, alright? Plus the weight of B times the times the expectation of RB, and again the same weight of A plus weight of B equals 1, sum of the weights. In other words, the realized return, so this one is realized. The realized return of a portfolio is simply the weighted average of the realized returns of its components. The formula extends to 3, 4, or more components. And the expected return is simply the weighted average of the expected returns of the components. The second formula also extends to 3, 4, or more. Alright, is this fairly straightforward? And now we get to the next piece, which is the variance. Variance, unfortunately, is not a linear relationship. It is a quadratic relationship. So, variance, sigma squared, is this how they give it to us? Yes, they give it as sigma squared. You get, first of all, the weight of the one times, how do they have it exactly? I just want to make sure.
WB.
They have it with, isn't it sigma B? It's got to be with WA, sigma A, WA, sigma A. So, you get the variance of the first one by its weight, and we square the two, and you add up the variance of the second one, B, times its weight. You also square that second piece, okay? And then you add up twice. Then you have the one weight, the other weight. So you have WA, WB, weight of A, weight of B times sigma A, sigma, sigma A, sigma, B. So, what you're having here for the variance is not simply the one variance, let's call this P. The variance of the portfolio is actually the sum of the weighted but squared, weighted squared of the first one, weighted squared of the second one. And this thing, if you remember that I was explaining it from last time, is actually the covariance between the two. The covariance between the two, alright? It's fairly straightforward. Now, let's move the camera over here, focus, and try to show you a few things the way I understand them, because the textbook simply doesn't show them, and without it it's fairly difficult to understand things. So, you have an asset, let's call this asset A. We have, what do we have on the plane here? We have on the plane a sigma. This will represent the risk or the variance, and this will give you R, the return, and we have some asset B over here. And suppose we mix up A and B, for example, 50-50. Are we going to get the point in between the two of them? And the answer is not really. Now, here's the trick. When you mix A and B, you get a point which lies exactly in between them, only when the correlation is equal to 1. In other words, when these two are perfectly correlated, you will get here 100% A, here 100% B, here you will get effectively 50A and 50B. 50A and 50B, if you actually fill into this formula, you'll see that this is exactly what comes up. But what happens if the correlation is less than 1? What happens if the correlation is, let's say, 0.9? Well, in this particular case, if it's 0.9 and you get 50-50, you will actually get a little bit better. You will get a little bit better. Now, a little bit better means that you will still get the same expected return, right? Now I have the one, which is A. This is R of A, right? This is R of B, right? So, you mix it up 50-50, one thing is for sure. You will be getting the same return. This is A plus B over 2. Actually, that's my mistake. Sorry, guys. It's RA plus RB divided by 2. But because of some diversification, you'll be getting a little bit less weight. Sorry, a little bit less variance. So, it's going to be like this. If you're taking 1/4 versus 3/4, it's going to be like this and like this. So, for a correlation of 0.9, you will not get the straight line, but you will be getting a line like this. Alright? Well, what happens if the correlation is 0.5? Well, then you will be moving further upward, and then it's going to go like this. Well, what if for any reason the correlation is a little bit like close to 0? Well, if it's close to 0, at first you may even have a little bit of lowering of the portfolio average, and then it begins to move like this. So what you're seeing is, as the correlation goes down from 1, you move further and further out. Well, what if the correlation is minus 0.5? If it's minus, in other words, these are actually negatively correlated. Well, if they're negatively correlated, you could offset quite a bit of the mutual variance. you could actually lower quite a bit the overall variance. So actually you will be gaining return and at the same time simultaneously lowering the portfolio variance. And it would work like this. Well, what if the correlation is minus 0.9? If it's minus 0.9, it will go more like this and like this. And then finally, what if the correlation is minus 1? What happens then? Then what happens is there will be a proportion of the two for which the variance is 0. Okay? But that's the one property. But the other property, remember, is over here the lines are straight where it's plus 1. So you can actually get this to the situation where you get a straight line over here and then a straight line over there. I didn't draw it quite straight, but it is straight, alright? Actually, and all of these curves will be within these two straight lines.
So this is the maximum situation.
Hmm?
The maximum.
I don't know anything about the maximum. Alright? So, all I'm saying is, this is what's happening. So, in the one case, when the correlation here, the correlation between A and B, let's write it in a better way. The correlation between asset A and asset B is equal to 1. And with red, the correlation of A and B equals minus 1. Alright? So, the idea is that you can mix the two, and if the correlation is very weak or somewhat negative, you could actually both lower the variance and at the same time increase the return. It's like money for nothing, right? It's return for free, effectively. So, this is the situation with two assets. So, now let's try to do the next trick. I'm wiping off and beginning again. Suppose now that we have 3 assets. Alright? 3 assets. Asset A, asset B, and asset C. Students would love to see them on a straight line, right? That's because this is how capital asset pricing model is supposed to work, right? Well, let's try to diversify between A and B, and let's say we have a fairly weak correlation, 0.3, 0.5. Then what you get is something like this. Variance lowers and then goes like this, alright? And with B and C, variance lowers and it gets like this, right? But now you could potentially mix A and C, right? You mix A and C and it goes like this and probably like this. Well, but it can also mix A, B, and C. So, what's happening as you move and reweight, you are actually able to make different combinations. And the combinations will go around these curves and still end up at A and C. Okay? Now, as you reweight and change the weights between the 3, you get this curve in the red, and this curve in the red is known in English as an envelope. Envelope doesn't have E at the very end. So you actually get the envelope of A, B, and C. Alright? Well, what if you have yet another stock? Well, you may have D, and if D is here, it's good for diversification. It may push the envelope out, okay? And finally, so this just shows how it works with 3. what if we ultimately have, let's say, 50 or 100 stocks? Well, suppose we have 50 stocks. Well, they will not be quite perfectly aligned on a straight line. So, yes, they will go around this line, but some of them will be a little bit below, some of them will be a little bit above. In other words, what I'm drawing here is, there is no perfect linear relationship.
Do you find the regression?
Again, regressions usually muddle your thinking. Usually the thought is not clear. The idea of econometrics is to confuse you guys. Don't get me, forget about regression. Regression doesn't exist. I never said anything about regression. All I said is we just plot them. If you draw a straight line, some will be a little bit above, and they will be providing a little bit of extra return for their variance, and others will be below, will be providing a little bit less. Some will be providing more, some will be providing less. Of course, this will not last forever. Over time, one will move the return up, other will move down. So what they will do is float in between each other. Right? I mean, you understand, if stock goes up 5% today, this means that the overall expected return will immediately fall by a couple of percent once you discount everything in the future. So the idea is, hey, today it's here, but tomorrow it could move here, and then it could move here. But at one particular static moment, they're not on a straight line, but right around it. Well, suppose this is what it looks like, then you can mix up all possible opportunities, and you will get a nice, beautiful envelope like this. And this envelope we call the efficient frontier. So, now I have to explain what efficient means. In order to get to efficient, we need to say what does it mean for a portfolio A or stock A, so a stock or a portfolio possibly of one stock, to dominate portfolio or stock B. It simply means that it has a better risk-return profile. Better risk-return profile simply means the following. Means that A has a better return than B, so RA is greater than or equal to B, RB. Okay? In other words, A dominates B, or is better than B, if return of A is greater than B, but at the same time, the variance of A is no greater than the variance of B. So, A provides you a better return, in other words, provides you no worse return for a smaller variance. Alright? So, this is what A dominates B. Okay? Well, is it possible for B to dominate A? And the answer is yes. B could possibly dominate A. And finally, you have A is the same as B. The same as B does not mean that it is the same portfolio. It simply means that they have the same return and the same risk characteristic. So, two portfolios are considered to be the same when the risk-return profile is the same. When the risk is the same, the risk is the same, and the return is the same. In other words, A is, we sometimes call this equivalent to B, when A dominates B, and what?
B dominates.
And B dominates A at the same time. Alright. Well, this of course is mathematically equivalent to RA equals RB and sigma A equals sigma B. It is mathematically equivalent, and the opposite is also true. Okay? So, one portfolio is better only in this particular sense of dominates B, and suppose you have here your portfolio A. Alright, let's try to see a case where A dominates B. Well, if this is B, then A dominates B because A gives you better return for a smaller, better return for a smaller risk. In other words, the way to look at A dominates B is you draw a coordinate running through B, and if you're in this quadrant, how do we call this quadrant? It's got a name, guys.
Second.
Yeah, the second quadrant. Yes, this is the first, this is the second, this is the third, this is the fourth. So, if A belongs to the second quadrant, then A dominates B. If A belongs in the fourth quadrant, then B dominates A. In this particular case, we properly say in English that A is dominated by B. Alright? So, A dominates B if it's in the second quadrant. A is dominated by B if it's in the... And the relationship between the two is indeterminate. So, if you're in quadrant 1 or quadrant 3, neither A dominates B nor B dominates A. Neither one is technically true. Alright? So, now we said that A dominates B. Now we get to the next concept, and the next, are you zooming in a lot? You have to zoom in a lot. And then you say that A is efficient. Efficient simply means that no portfolio dominates A. Alright? It simply says, hey, if this is B, and if B is efficient, I'm switching the portfolios to the chart. If this is B and B is efficient, it means that there is no point which exists in quadrant 2. In other words, B is efficient if there is no portfolio which dominates it. Okay? So, if B is here, nothing is in A. So, let's try to now look at this graph to show that it is efficient. Well, efficiency begins from here, the leftmost point. So, over here, this graph is certainly not efficient. Of course, this point is not efficient because it's dominated by this, right? Dominated by this, dominated by this, by this, by this, by this. In other words, all of these points are strictly dominated by this. Alright, so how do we define? I use the brand new term, strictly dominate. Strict domination, A strictly dominates B, is when RA is strictly greater than RB, and this holds. Alright? In other words, for the same variance, you get more of a return. So, because each of these points is dominated by more points, none of these points is on the efficient frontier. Alright, well, let's pick one point. Is this point dominated by anything? And the answer is, well, let's take a look. We just draw out the quadrant, and there is nothing in this quadrant. Then we take this one. Again, same story. Nothing is in this quadrant. And again, here. In other words, the frontier is efficient as long as for each point at the frontier, there is no point which is located in quadrant 2 from that, we say, originating from that point. Alright? So, we have a coordinate system originating in this point, and nothing is in quadrant 2. If this is the case for every point of the frontier, then the frontier is efficient. Alright? So, what we simply do is we have 2, 3, or 50 components, meaning stocks, or we just call them assets. When we draw all possible combinations, we choose those that are to the north. It's going to be northwest corner, right? And then those will be the efficient. And we pick it, okay? And that's it.
A and B are assets or portfolios.
Okay, A and B, assets or portfolios. The answer is portfolios, but these portfolios could be single stock portfolios. In other words, A and B could be just 2 different stocks. A and B could be 2 different portfolios. It is best to think as A and B as only one stock. A is one stock, B is a second stock, C is a third stock. Because now once you start mixing portfolios with portfolios, you get to covariances, and these are, I don't want to get into block matrices, it's a little more complicated. So the simplest way to think is that A and B are simple stocks. But the properties generalize to A being a portfolio and B also being itself a portfolio. Alright? So, this is the efficient frontier. Is this good enough for now?
That means that no asset dominating.
Yes, exactly what it means. Efficient frontier simply means that no combination, not no asset, no portfolio. Remember, one point on the frontier represents one portfolio. A different point represents a different portfolio. So, no single portfolio on the frontier dominates any other.
Because return is increasing and risk is increasing too.
Yes, because at all times you have both simultaneously return increasing and risk increasing. So, the efficient frontier has the property of always moving, having a positive slope, and always moving upward and to the right. Upward and to the right. And this is what defines or determines the efficient frontier. Is this a little easier to understand? I hope so. Alright. Let's see what else we have. Okay. Efficiency, dominancy is covered. Diversification between 2 correlated assets simply does not work, okay? If they're not correlated, you begin to gain. Let's try to show what really means diversification with little correlation. How to think about diversification? There are 2 ways. They are equivalent, they are identical, but sometimes in finance it's nicer to think the one way, and sometimes it's nicer to think the other way. So, you get here A asset, and you get here B asset. What does diversification mean? Means if you begin from 100% A, and you start adding up B, you gain originally, diversification means early on, you gain an awful lot of return for a relatively little risk. So over here it is extremely steep, okay? It's extremely steep. Extremely steep means you gain a lot of return for adding just a little bit of risk. Well, that's the one way to think about the diversification. The different way to think about the diversification is you start with B. You start with B and start adding 1% of A, 2% of A, 3% of A. Diversification works and works well. It simply means that you are rapidly lowering the variance of the portfolio for only a little bit of sacrificing return. In other words, over here it's going to be very, very, very flat. So, steep means you rapidly gain a lot of return for very little additional risk. Over here, it means the opposite. Well, it's equivalent. You rapidly lower the risk and sacrifice very little. Well, lowering a lot of risk, sacrifice a little means that the slope is very flat. Over here, the slope is very steep. So, diversification between relatively low risk and relatively high risk asset could mean for the low risk asset, you rapidly increase your return without actually adding a lot of extra risk. For the high risk, it means you rapidly lower the risk without sacrificing most of the return. And of course, the curve will be relatively smooth over here between the two. So, this is how you should think about diversification between two assets. Alright? Is this good enough as an interpretation? Alright, let's see what else we have. That's fairly straightforward. Some of this stuff which I've been doing is actually shown on my pages 174, 64. You're actually seeing some of this stuff which I've been explaining it, but unfortunately didn't see it well explained in the textbook. Alright, so we're now moving on to the next concept. Well, the next concept is fairly straightforward. Suppose you have, again, those same assets, maybe 100 of them. In those assets, you get some efficient frontier. And on top of that, you also get, so the efficient frontier is made up of only the risky assets. Well, let's throw in now a risk-free asset. What can we say about the risk-free asset? Well, it will be on this vertical line because by definition, the risk-free asset has a sigma of 0. So, the risk-free asset is here. And now we can do some further diversification between the risky portfolio and the risk-free asset. So, if we choose this particular point of the risky portfolio, and we have this is the RF, and this is the RF, you can attain any of these points by choosing the appropriate weight of the whole mixture of assets. So this will be representing possibly 100 stocks. Could be 200 stocks, could be 500 stocks. And you mix them up with the risk-free. This means that you will put in, for this point, 50% of your risk-free in the risk-free asset, and 50% will be in these 100 stocks. Over here, you'll be putting 75% in the risk-free asset and only 25% in those 100 stocks. So, if you choose to invest in this efficient portfolio and the risk-free asset, what you get is the straight line between the two of them. It is a straight line because RF is not technically correlated with this portfolio. Alright? I mean, this is what we started with between a risk-free and a risky asset. So, can we do better in the asterisk? Sure. We can choose a point above this one, and instead of using this portfolio P1, we can choose portfolio P2. And if we choose portfolio P2 and do the same, we see that RF in P2 strictly dominates RF in P1, right? In other words, if you can attain this point here, you can certainly get a lot of points which belong to quadrant 2, alright? So, for whatever it's worth, no one will be choosing P1. Simply because everyone could choose P2, diversify with the risk-free asset, and get a dominant portfolio. In other words, get both a better return and at the same time lower risk. Alright? So, if this is the case, then the risk-free in P2 dominates risk-free in P1. But we extend the logic further. We go to P3. Well, can we say that now the risk-free combined with P3 begins to, or dominates the risk-free in P2? And the answer is yes, you can always find a combination of the risk-free and P3 that strictly dominates risk-free in P2. Is this fairly straightforward? Is it logical? So, we continue with P4 and do the same, but if we go all the way further out, this is no more the case. In other words, when you're trying to do this, you see that from here to here, if you're using this P20, let's say 20, mixing up risk-free with P20, this is certainly not efficient. And this is certainly not efficient. We can improve. So, over here, we can improve by moving upward. Alright? But over here, we can improve by moving leftward. And we move all the way here, we move up here, and we will meet somewhere over here. Well, this point has a beautiful mathematical property, and the property of tangency. Alright, in this case, actually it's here, the tangency. So, this will represent the optimal portfolio, and every investor will be choosing this particular optimal portfolio with the risk-free asset. And if you're choosing to the left of the risk-free asset, of the optimal portfolio, they are choosing less than 100% of the optimal portfolio and some positive weight of the risk-free portfolio. And if they choose further out, they actually short the risk-free portfolio and are investing the proceeds from shorting into this optimal portfolio. Alright? Is this fairly straightforward so far? Alright, let's see now what we have to 5.3. Optimal risky portfolio. So, I just gave you the optimal risky portfolio. It usually combines with the risk-free portfolio. This line here has a name, and it's called the optimal allocation line. Optimal allocation line. In other words, the optimal portfolio mixing up with the risk-free asset gives you the optimal allocation line. That's fairly straightforward. 6.3 is complete. 6.4 simply tells us what I have been already explaining, as just like you have two assets, the logic and the application extends to 3, 4 or more, and the logic applies in exactly the same manner. We call these points here, they have a name, we just call them, yes, individual assets. Individual assets, and respectively efficient frontier.
These P points are the portfolio points.
Yes, each of these is a portfolio point. Remember, inside, you can take inside, and this will be also a portfolio. So, these blue points are individual assets. Now, you can take points in between those two, and these points will be represented portfolios made of those individual assets. Okay? That's what it is. And now, here's the trick. If you take a portfolio on the efficient frontier, we say, there is a special term, that this portfolio is efficiently diversified. So, this portfolio is efficiently diversified. Efficiently diversified means that you cannot reallocate the individual assets in any way to obtain a portfolio that dominates this portfolio. So, there is no possibility. So, in other words, a different way of defining the efficient frontier is that the efficient frontier is contained or contains only efficiently diversified portfolios. A different way of saying the same thing is that all efficiently diversified portfolios make or contain the efficient frontier. Alright? Or constitute the efficient frontier. Is this very straightforward?
And these portfolios are for a single stock or combination?
You mean what, the efficient?
Yeah.
Oh, of course, efficiently diversified means it uses a lot of them. If you have 100 assets, it does not necessarily mean that it contains all of those 100 assets. Maybe it contains only 80 or 85 or 95 or maybe 8, okay? So it is not necessary that it contains all individual assets. In the real world, it will most likely contain most of those assets, but not necessarily all. Does this answer? Let's see what else we have now. Choosing the optimal, okay. Single factor, actually I'm done with the core the so-called core of portfolio theory. So I'm moving now to 6.5 with single factor asset markets. And this is 6.5 and 6. Just good enough to finish, hopefully, this chapter today. So, now we are to 6.5 single factor models. Is this how to say asset markets? Single factor asset markets. I will say single factor model. Okay? And usually single factor should be with a dash. Yes. So, we need some definition. First of all, we need what is a factor model. Well, first of all, what is a model? Well, model is a quantitative relationship between two or more economic variables, usually based on some sort of economic, or in this particular case, financial theory. So, this is what a model means. And a factor model means that one variable is affected by another variable. The variable which is affecting itself is called a factor variable. Sometimes in statistics we call this the independent variable. So sometimes we call it the independent variable. So a factor model becomes, I use statistical model designed to estimate the relationship between two different components or two or more different elements. Alright? So a single factor model means that it is a statistical model which designs to give you the relationship of one variable driven by a single factor. In other words, attempting to explain it by some other variable. Is this fairly clear so far? This is exactly what the rest we're doing now. I will be giving exactly this. An example. So, this type of stuff I just mentioned was developed by William Sharp back in the old days, in the 60s. Yes, in the 60s, 1963. And all that you do is very simple. It's actually what we are saying here is that this model is only one model. So it's only one example. You take the excess, oops, my mistake, excess return on the stock here, and you take the excess return on the market. So, the market has a certain expected return, right? And the stock has a certain expected return. And so now what we simply do is simply observe what actually happened on the market. So, you get the market excess return, and market excess return was, let's say, 10%. You get some for the particular stock. For example, Microsoft, MSFT. You get one. Well, the next quarter, you get a different observation. Market gave you a lot more excess return. You also get a lot more in Microsoft. Well, of course, the market could possibly give you a negative return, and here is negative return. So when the market fell, Microsoft also falls. It just happens. Okay?
Is it always a positive relationship?
The answer to this question is only when the stock correlates positively with the market. In other words, most of the stocks actually do correlate positively with the market. But not always. Maybe 95 do, maybe 5% don't. It is not necessary. So, you take a third quarter, there it is. You take a fourth quarter, there it is. You get a fifth quarter, there it is. Sometimes the market will provide a positive return, excess return, and the stock will provide a negative return. Sometimes it could be the opposite. You will actually get a negative return for the market, and the stock will give you a positive return. That's perfectly possible. In the real world, that's exactly how it works, okay? So, what you get is a number of points, and when we say that we do a statistical model, we certainly do a statistical regression model. The regression model is typically linear in nature, and this means that when we try to establish the relationship between the two is linear. In other words, a straight line. And we try to find a straight line which best fits all of those observations. And the line that best fits is just called a regression line. And we run the regression. And statistically or ideally, it should go through the origin, although it is not necessary. When you run a regression line based on a sample of observations, of course you do not have the full complete set of 1 million points, right? So you just have, let's say, 25 quarters, have 25 points. Of course, the regression line may, for statistical reasons, due to the nature of the sample, be a little bit above or below the origin. It does not have to necessarily go through the origin. So, actually, in the textbook, as you will see, most of the charts here on 611 and 612 actually do not run through the origin itself. They run a little above, a little below, okay? So, this is observation number 1. Now, this particular line is for one particular stock, MSFT. You may get a different stock. A different stock could be, let's say, Dell. So, this will be Dell, okay? But the second stock will have a second regression line. And of course, you may have a third. Something like this. In other words, the market gives a lot of returns, the stock gives relatively less returns. Alright? So, this is a perfect possibility. What could be a stock like this? For example, some pharmaceutical company. Alright? In other words, the excess return of a pharmaceutical company is not as affected by the market itself. Alright? So, let's move on and see.
Why is that, sir? Why is that?
Well, I'm getting to this for the next 10 minutes. That's what I'm doing now. So, first of all, these curves have a slope. Alright? And the slope in a regression is simply, no, it's not 1, it's simply called a beta. Simply called a beta. In other words, when you run a regression, the regression is y is equal to a plus bx. Okay? This is what a regression looks like. We call this simple regression. Simple regression. And x we call, how do we call x? The factor. Factor. the factor, okay? And the factor, we also call it an independent variable, okay? And y is the dependent variable. So, when you estimate A in statistics, how do we get the estimate of A? Not how do we get it? How do we call it?
Why did you say?
No, how do we call it? The estimate of A in statistics. You're on record? Yes, you call it alpha. Alpha. In other words, A is the true parameter in the true relationship. If you have an infinitely large sample or the complete sample, all observations, then the statistical estimate alpha will coincide with A. But if you only have a sample and the sample is incomplete, then alpha will be an estimate of A, and given beautiful statistical properties, it will be an unbiased estimate of A, okay? And alpha is the estimate of A. By the very same token, if you have B, the estimate of B is called beta. This is how it's. And B, which is beta, represents the slope. This is elementary high school algebra, right? A plus bx, where A is the what?
Why did you say?
No, A is called the intercept, and B is called the. Let's write this out. This is high school stuff. That was like 10, 15 years ago, right? So, intercept, right? You guys are having fun? Alright, so intercept and slope. So the slope is B and parameter is B and the estimate of the parameter is beta. Alright? So there you have it. So beta represents the relationship between the factor, which is in this particular case excess market return. Remember, excess market return. And y represents, in our case, the excess return of the particular stock. So, this is the one and effectively only major example. So, in this part of a single factor asset. Now, you can choose any other factor that you like. And the question is, are you going to get strong correlations, in other words, a strong relationship, or a weak relationship? If you try to correlate the excess return with the sum, the correlation will be very weak and probably zero. If you try to get a correlation between the stock and the rain, again, it will be zero. If you try to get a correlation between the stock and the price of oil, yes, they will be correlated, but the correlation will be weak. Maybe 5%, 0.05, maybe 0.1. Alright? A correlation of 0.05 is not much of a help for practical investing. You don't want to invest on a correlation of 5%, right? You want to have at least 50 or 80 or 90%. In other words, oil is not a good predictor or not a good factor in determining the excess return. So, scholarly research has simply shown that using a well-diversified index for the whole market does the best job when it comes to single factor models. So, if you have to choose one factor, it is the S&P, in other words, some relatively large and well-diversified proxy of the whole market. Weather doesn't do the job. Temperature doesn't do the job. The price of gold doesn't do a good job, alright? So, of course, you can run it for everything that you wish and just establish if there is a relationship and how strong the relationship is. Okay, so let's see what else we have. Well, now we're coming to your question. Well, let me wipe this off and move on to what if the relationship is negative. So, you get the return of one particular asset or one particular stock, and you also get in both cases, you just get excess, okay? Excess here, excess here, and it could just turn out that whenever the market gives you a positive return, the stock could be giving some negative returns, and vice versa. When the market gives you a negative return, the stock gives you positive. Well, question, is it possible for some reason that when the market is positive, the excess return of the stock will be negative, and if the market is negative, the excess return will be negative again? Well, the answer is not really. In other words, no matter what the market does, you're always getting a negative excess return. In other words, it's a really bad stock. In other words, you can't, because as soon as people realize that this happens, no one will be investing in this stock. Alright? And if no one will be investing, its price will collapse. Okay? And then people might. So, you cannot possibly have that the stock provides consistently negative returns simply because no one will invest in it, okay? Or if because no one will invest, the price will fall many times, and then that excess return will become back to positive, alright? So, in other words, you expect the price to be 70. That's the expected future price, 3, 5, 8 years from now. And right now, the price is 100. So, you're expecting some negative returns. Well, what if everybody expects those negative returns? Well, the price from 100 will simply collapse to 30 because everyone's expecting those negative returns. Everyone will be selling. And once the price is down to 30, now the stock will be providing attractive returns again. And people will be buying it again. Alright? So, you cannot be mostly in the negative territories because everyone will be selling and push the return to the averages. And by the same token, the stock cannot be in the positive area for too much and for too long because investors will see that it's in the positive area. For example, right now it's 10. Everyone's expecting 70. Well, that's an awful lot of return. A whole bunch of buyers will jump, drive the price to 30, and then the return will normalize. In other words, as soon as investors see consistent negative returns, they'll sell, drive the price lower, and drive up the expected return, and vice versa. Alright? Is this fair and straightforward? So, usually staying underneath and staying above doesn't work. It works either in a positive way or in a negative way. So, you can get yourself actually a relationship like this. Perfectly possible. What does this mean? It means the market gives you a good positive return and then the stock gives you a negative return. Well, why would you want to invest in this stock? Well, you would want to invest in this stock because when the market gives you a negative return, this stock actually gives you a positive, expected positive return. So when the market gives you a negative return, but this offsets the losses on the market, we have a very special name for it, right? We just call it a hedge. Okay? We just call it a hedge. And that's the economic and financial meaning. In other words, a slope is negative. In other words, a slope is negative when, slope is negative means that the beta of the stock is negative, and when a beta of a stock or a portfolio is negative, then the asset is called a hedge. By the same token, you can have only a hedge of some portfolio if it is negatively correlated with it. Alright? So, simply the definition of a hedge is negative beta. Or, any asset with a negative beta is simply a hedge. Alright? This is fairly straightforward. Of course, now I have to think. You always have to say hedging against something. You can hedge against the whole market. Well, does Saudi Arabia, let's say, be concerned with hedging against the market? No. Saudi Arabia's got one big asset, crude oil. So what Saudi Arabia should be doing is hedging against the falling value of crude oil. Alright? So, now, if you have one asset, one portfolio, you have to be looking for assets that are uncorrelated or negatively correlated with that particular asset. So, every portfolio's got its own fluctuation in behavior, and that particular portfolio will have some other assets or other portfolios which will act as a hedge. In other words, just because one asset is hedging a portfolio of stocks, it does not mean that it will be hedging a portfolio of commodities. Alright? Put it differently, you can get a portfolio of stocks, and if you want to hedge those, you can use a portfolio of commodities to hedge the portfolio of stocks. Alright? So, the hedge itself does not need to be one single asset. In this particular case, it is, because I drew it that way. But usually, a portfolio will need a hedge, and you can hedge it with a different portfolio, not necessarily with one asset. Alright, is this clear? Question?
There's a negative market return when you hedge.
No, I didn't say there is negative market return when you hedge. What I'm saying is that when the market return turns out to be negative, the hedge works when you actually get on your hedge a positive return.
Your stock.
In other words, a hedge is an insurance against a bad outcome. So hedge means that only when the market provides you a negative return, your expected return on your hedge must be positive. So if it is positive, it is a hedge. But if the expected return is not positive, then it's simply not a hedge. Alright? And that's the idea. Alright? Is that fairly clear? Let's see. I just want to finish this chapter. I'm very close to the end. And I'm actually finished. So we're done for today.